Hello? Hello, hello, friends. Mic check. How's everybody doing? Good to see a few of y'all hanging out in the chat already. Go ahead and smash that thumbs up button. What's up, everyone? What's up, David? David gifting a membership right off the bat. Two Davids don't make a right, he says. Two Davids, one cup. What's up, Brandon? What's up, I Hear Clear? Welcome, gentlemen, folks, everyone, friends. Let's get it. Hello, hello. Welcome, my friends, to Alpha Beta Soup. It's your boy, TXM Sizzle. Smash the like button. Say hello to your friends and compatriots in the markets. It is Thursday, January 18th, 2024. We're coming out of a bit of an uncomfortable freeze for us here in Central Texas, but nothing we can't handle. Hope everyone's doing great. Have a few topics in mind today to discuss as we get settled in here. Nothing quite as big picture as we talked about the last couple weeks, but definitely a couple things on my mind that I just want to look at together, get your thoughts on. Thanks for everyone for being here so soon. It's great having like 50 of you guys already in here when we start the stream. That's amazing. That's a bigger number than we used to have. Could definitely see the growth happening over time. Excellent. If you are not already subscribed to the channel, please do so. If you see anyone in the chat with a green name, it's because they have become channel members for an extra $5 a month. You can do that too. And it lets you have access to our private member streams. We did the first one 2 weeks ago, and we'll do another one probably 2 weeks from today. If you'd like to participate in those things, show support to yours truly, and become an even more recognized member of our growing little community here, then consider joining yourself. But it's certainly not necessary. We will continue doing these streams. I am TXMC, and just before we get started, I like to remind folks that I am not a financial advisor. Do not take my words as investment advice. They are the opinions of a single man on the internet, and you are here for the entertainment I bring. And with that, let's get into it. So let's look at BTC first. BTC is just under 42. We're still hanging out in this area here. I think that this is a very ugly technical place for Bitcoin. Despite the narratives, like let's just kind of put the narratives aside for a minute. The ETF, the halving is coming up. You know, equities are at all-time highs. I get it, but let's put those things aside for a second and let's just look at Bitcoin, its market, its ecosystem by itself on its technical merits, okay? So if we just look at Coinbase, for example, let's look at BTC on Coinbase. I think that we're in a really ugly technical spot. And the reason I say that is because last week on the launch of the ETFs, we saw some signatures get put in, not just on the Bitcoin price chart, but on other related markets inside of BTC. I'll show you those in a few seconds. That look like a reversal signature to me. I saw that my friend Blockchain Backer talked about this too, and some of you guys go and watch his streams before mine, so he might have made some of these points already. I didn't watch his whole stream today, so I don't know. But there's some things to take note of here that suggest that maybe the rally is running out of steam here. Doesn't mean it can't pop higher again once more, but I do think that the majority of the upside has already been captured for Bitcoin. One of those reasons is because of what this looks like right here. So I said we're on Coinbase. If we look at this on a weekly chart, this wick that we put in last week was a perfect, picturesque sweep of a 2-year high. from March 2022. This was the high right before Luna collapsed, which was about right here. And we just swept this high now 2 years later. We swept it on high volume. This is a weekly chart, the highest volume since this moment back here on Coinbase on a weekly basis. On a daily basis, on that sweep right there of that high, was the highest dollar volume on Coinbase in 3 years. So we talked a little bit about some of these things last week, but I want to touch on this a little bit because this is what's been on top of mind for me. So we mentioned that it was the 618 and it was the 2022 high that we had swept. We were talking about that last week, but when we did the stream last week, it was during the formation of this candle right here. So I wasn't really sure, is it going to look like a clear reversal or what? This candle was still developing. Well, that candle is now closed. You can see what it looks like. And we've put in this really picture perfect sweep of this level. And if you look at dollar volume, which is not just the volume indicator that comes with TradingView, but it's that times the price, because this is units of BTC. The dollar volume on Coinbase on a single day, January 12th, was over 2 billion. And that's the highest since May of 2021. Back here, when we were collapsing because China had banned industrial mining. And Tesla decided they no longer wanted to accept Bitcoin as payment for vehicles. Like those things happened almost at the same time. And it was during this massive flush of leverage that had built up in the first half of 2021. That's the last time volume was over $2 billion on Coinbase. And it happened last Friday on a major sweep of the 2022 high after a huge move up. A huge move up in 2023. It was up 190%, almost 200% in 2023. And that's where it printed the sweep on the launch of the ETFs. That is, if you, like I said, if you strip out all the narratives and you're just looking at this chart and you don't know anything else about it, that looks like a reversal. That's what they look like, right? That's the same thing the COVID low looked like going the other way. Right here. The highest volume in a year on a major swing. They didn't sweep a key level, but the volume profile is kind of the same, just like this top on this retrace here. You see this high volume absolutely blowing out all the volume from the prior bear market. This is probably a better example than COVID because this is actually a mid-cycle retracement, not that different from the one we just put in, and it goes, I believe, to the same fib level. Yeah, the 618, which is just literally what we just swept on 2024. So this signature right here is exactly what this looks like. And this is just Coinbase, right? And Coinbase is one of the bigger markets. It's not the biggest. Some of the perp markets, like if I go look at Tether over on Binance, look at the Tether perp on Binance, it does more volume. But it always does more volume. You can see. And its volume signature doesn't really look that crazy. But the reason I think it's interesting on Coinbase specifically is because it is only a spot market. And they are also the custodian for a lot of these ETFs. So for them to have printed a 3-year high on volume on a major sweep of a key level, that looks like a reversal to me. And then if you just kind of look around the market, you look at some other things, you look at GBTC, look at the volume on GBTC, literally the all-time high in dollar volume for GBTC, higher than any point in the bull market. And it swept the 702, the dreaded 702, and now it's back below the 618. That's an even sharper move into retracements, slightly different from the 618 sweep that we got here on Coinbase, on the main price chart for Bitcoin. So GBTC did that sweep. Also, BITI, which is the short ETF. Look at the volume in dollar terms here from was this Thursday or Friday? This is actually on Thursday. So Thursday and Friday trade off being the day that has the highest volume on these instruments. But you can still see this is the short ETF, highest volume since FTX collapsed. which was the high for this instrument because it was the low for Bitcoin. But here we are, and it looks like reversal style volume on a V bounce on the short ETF from last Friday. That doesn't look great. Then we look at BITO, which is the long futures ETF. What do you see? The same fucking thing. All-time high volume. A day after, all-time high green volume. So all-time high buying volume on Wednesday the 10th in anticipation of the ETF launch, right? That's the day we got the fake tweet from the SEC hacker guy. And then the day after that, we set another record, but on a red candle. And it blows out the previous all-time high. And again, prints a reversal looking structure. You see that? Look at that huge candle right there. That's a red candle. These filled in colors, that's a red candle right there. These things just, they look ugly. So I think that it's going to be difficult for BTC based on my bias, my general bias that this is a retracement and that this is not the beginning of a bullish continual uptrend for BTC. I'm leaning toward this being possibly the high for Bitcoin. It could pump again. Sometimes you see another little snap higher, but if it's on significantly less volume, that will be a tell, right? That will be a tell of diminishing underlying strength, just the same way that this was. The same way that this was an all-time high on lower volume and lower strength, right? Like if you just look at the RSI, the RSI was nowhere near what it was the year before. That's on a daily chart. You look at it on you look at it on a weekly chart, it's even more clear. Bearish divergence, price going higher, underlying strength weakening, lower volumes. So if we get something like that over here, I don't know what the fractal looks like, but if we get another pop like that, but the volume looks like this, RSI looks like this, like one of these, maybe volume is one of these, a little bit lower, that could be the tell right there. Can't say for sure, but that's how I'm leaning right now on BTC. And I've been looking at the flows into the ETFs. Here are the ETFs, by the way. They're starting to break down. They're breaking down. Before I look at the flows, let's just look at the price charts. Here's the ETFs. Top left is Bitcoin as a comparator. Then we have the BlackRock ETF right here in the top center. We have GBTC in the top right, and then Bitwise in the bottom right. These three right here are the three big ones. BlackRock, GBTC, and Bitwise. They are the volume leaders. One of them, GBTC, has predominantly outflows, whereas BlackRock and Bitwise have predominantly inflows, but they're kind of offsetting to some degree. However, one thing that really stands out to me, though, is look at the volume profiles on these. See this? This is dollar volume. This is my same indicator that was colored on the other chart, dollar volume. And you can see the breakdown here. It was a huge surge on the launch of the ETFs. The first day was high volume. The second day was less. The third day was less. The fourth day was less. And we just kind of have this structural settling in of volumes. That's part of the reason why anyone who is extrapolating the inflows over the first 2 days into the future is probably going to be wrong, because they're extrapolating 2 or 3 days worth of data points on a structural downtrend in volume. Doesn't mean it's just going to keep going down. It will find a bottom, and maybe this is it. Maybe this is the zone. It is a BlackRock product, so I would imagine it's going to hold some volume, especially since it's attached to a $900 billion asset. However, I didn't get overly excited about the launch because I've seen these things before. We've seen launches of new financial products before. Like, I've shown this on here before, but I'll just remind you guys in case anyone's maybe watching TXMC for the first time. Bitcoin has a bad history with new financial products being launched. Right here is when the CME futures launched. right here is when Coinbase made its direct listing on the stock market. Now, it was already a trading venue, but that was its public coming out party. It was like its quinceañera for the stock market was Coinbase IPO right here. And then right here was the BITO futures launch that we were just looking at, having had all-time high volumes. This right here, BITO, right there. That instrument was launched right there. I fucked up my arrows. Sorry, guys. Fucked up my zoom on my arrows. There, it was like that. Let me take them off. So we got CME right here. We got Coinbase right here. We got BITO right here. And then right there, we get BITI, the short ETF, literally at the bottom. And then right here, we get the spot ETFs. So like we don't have a great history with these things. And when you see that combined with the technical analysis we just did, just the signature of the candles and the volume across multiple Bitcoin related instruments, it looks like a reversal. No two ways about it. It's hard for people to understand that or to accept it because people think in terms of narratives and they think in terms of, well, there's $1 billion of inflows to these ETFs. There's all of this hype. We have the halving coming. We already had the bear market. Crypto has a 4-year cycle. Equities are at all-time highs. The Fed is going to start cutting rates this year. Like, all those are narratives. They're not the fucking price chart. And the price chart is telling you that that was a moment of exhaustion. It was a moment of buildup after months and months of an uptrend. And not only did it print a technical reversal, but you could almost see it coming. And I'll show you what I mean by that because I tweeted about it yesterday. Let me find my tweet before I show it. Here we go. So this was me from yesterday, and this was a text that I sent to BCB last week. Wednesday, January 10th. I texted him this, and it was this tweet right here. Justin Bloomberg predicts $4 billion in spot inflows on the first day with the possibility of $2 billion directly from BlackRock. Well, it wasn't $4 billion of inflows the first day. However, when you see something like that, after a huge move up in the asset with tons of anticipation around the event, and then that event tells you that there will be 9 figures of spot demand volume coming in on a given day, that is exit liquidity. That is a target for exit liquidity right there. See this? Exit liquidity cometh. That was the first thing I thought when I saw that. Holy shit, a day with massive hype, and they're literally telling you they're coming in with big guns. They're coming in with $4 billion in big guns. Well, what happened? GBTC unlocked multi-year holders with the highest management fee of all 11 instruments. Bunch of people been holding GBTC while the discount went as low as 50% 3 years ago. Like they've been holding for 3 years. The discount went as low as 50% around this time of the year last year when Bitcoin was at its lows. But people have been holding Grayscale since back here. And they finally got let go over here at the 618 retrace on a sweep of the 2022 high with signature reversal volume printed on almost every instrument that we look at of significance. So I'm not predicting the future seeing this. It's just the way I felt, and it's exactly how it played out. And I said here, takes me back to March 2022 when Saylor and Do Kwon were publicly buying 9-figure stacks and they got sold into. Do you remember that? It was this period of time here on the chart. We had just had the high in November 2021. Here was the start of 2022. Right around here was when Russia invaded Ukraine and, the market started getting really scary. But then we started shopping around. And here in March and April, this period right here, Michael Saylor announced a huge buy of Bitcoin, and Do Kwon was building up Bitcoin reserves for Luna Foundation Guard. And those were happening right in here. And even though they were doing that, they did it publicly, there was a ton of sell volume pumping into their buy liquidity because they fucking announced it. So everyone who wants out they're gifted a super soft landing pad for their exit. And that's what happens. People think that because Bitcoin has a finite supply, that it's capable of magical things. But if you tell everyone you're coming in the market with big guns, someone is going to trade that. They are going to trade against you because that is what the market is. That's how it works. So when we got the same kind of announcement over here after a 200% year, I mean, the writing was on the wall. If we look at the flows, this is Eric Balchunas. I know I'm mispronouncing his name. Sorry, Eric. He works for Bloomberg. He's one of the ETF specialist guys who's been covering a lot of this stuff. And he shows the flows from all the different instruments from the first day. I thought it'd be interesting to just kind of look at these. BlackRock here at the top. Fidelity is second. Bitwise is third. Flows are this first set here. So these are the flows. This is the actual like net flows into the asset. And the thing I think it stands out to me here is a couple of things. One, there are some of these instruments that are recording higher flows than they have traded volume. And so that's just a little weird. Like here, the Valkyrie ETF, they have $35 million. Is that millions? Yeah. $35 million of flows, but they only have $15 million of traded volume. So someone got in OTC, some kind of dark pool or something like that. But the Bitwise one here, this is an even more egregious delta. Look at that. $373 million of inflows, only $300 million of traded volume. So there's a $70 million delta between the actual shares trading hands and how much has gone into the fund. And if you look into this, Bitwise, 200 million ETF. Here. Sorry, my black lines are all over. Bitwise, $200 million plan to seed spot Bitcoin ETF. Because there is an authorized participant named Pantera Capital, one of the entities that's helping them facilitate this. They mentioned that they want to put 200 million in. It was in the filing. Like it's right here. It was in the filing with the SEC. But then when you go over here, they're counting that as inflow volumes, like organic inflows. 200 of the 373 was in the SEC filing. They technically started with that. So this really should say 173 million versus 300 of traded volume. So this number's cushioned a little bit. It's padded a little bit. The BlackRock one, that looks pretty impressive. We'll be honest about this one. This, not that we're never honest, but this one does look pretty good. That's $1 billion of inflows to the BlackRock ETF. If I look at BlackRock IBIT, you can go to their website and you can see how much is in there. Let's go over here and look. Required only. No, sorry, wrong page. This page. They have two different pages for it. It's very confusing. Let's see, where's the holdings tab? Here it is. Yeah, here. See this number? This is how much BTC they have. Let me make this a little bigger for you guys. 25,000 Bitcoin. When I was looking at it the other day, when I looked at it Monday? No, sorry. It was either Monday or Friday. Monday was a holiday. Whenever I tweeted about BlackRock 10xing their shares, I think it was on Friday, they had 10,000 and now they're up to 25,000 BTC. So they went from 200 to 25,000 BTC in like 4 days. That's amazing. That's great. It's a lot of demand. That's about $1 billion. Yeah. Notional value, $1 billion. That's about a billy at 43,000. That's really impressive. What I think people should take time to consider when you hear that kind of number, most people see that number and then they immediately go to the train of thought of, well, Bitcoin's a scarce asset. 25,000 is such and such percent of daily inflows. And if the halving is coming and we're going to cut that in half, then, oh my God, we're going to have a supply squeeze and the price is going to $1 million. But that's way too simplified of a way of looking at the market. And unfortunately, that is what a lot of people on Twitter do. If they look at the market that way. Where's my little blue dot? There it is. The thing that I think about when I see this 25,000 Bitcoin is the fact that they did that while price did this. Like they acquired 25,000 Bitcoin during this. And it's because they have sources. They are not going to Coinbase like I would be going to Coinbase and saying, I want to buy one BTC or whatever. Like that's not their process. They have different rails. They have access to liquidity that you and I don't have access to, unless you're listening to me right now and you're one of the OG Bitcoin whales. You have access to those things. You could get on the phone with Cumberland or Falcon X or Gemini and say, hey, I've got a huge stack of BTC. I'd like to offload some. I need you to make me an order. And they'll build you an order and they'll give you a quote. And you can do that. So can BlackRock. All of these ETFs have that. It's what I've been tweeting about. It's the kind of thing I keep saying on my feed is that people are underestimating the depth of the market. They underestimate the market's ability to find supply. And that's because there are these pools of liquidity that you and I don't see. And it's why the exchange balance number does not represent the available Bitcoin in the market in any way. It represents a portion of it. But even that number, the exchange balance number that you see on, let me close this, the exchange balance number we see on Glassnode, if I go pull it up, this number is not all encompassing. There are aspects to the market that are just not in here. And there are exchanges that are just not in here. This is not an exhaustive list. I could think of 5 or 6 of them right now that aren't on here. And many others probably exist that I'm just not that familiar with. Some of them might be really small, and so in the grand scheme, they're irrelevant. Some of them are quite large, like Robinhood, right? Huge. Fidelity, not on here. Those are places that hold Bitcoin for clients. Robinhood being a very large one. Robinhood has billions of dollars of Bitcoin. Robinhood has more Bitcoin than BlackRock. They're not listed on here. There are a bunch of people who have Bitcoin on Robinhood. So that's not even listed on this number. But I constantly hear people doing math on the 2.3 million Bitcoin on these exchanges here and thinking that they've got it all figured out. But those people just don't understand what they're talking about. And now I'm detecting, as I look at the market and I listen to people on my feed, and I hang out with a lot of Bitcoiners on Clubhouse. A lot of Bitcoiners have been around for a couple of cycles. I listen to the things they say. Some of them are my friends. And the narratives are kind of amorphous right now. Like one of the things people are paying a lot of attention to is the flows out of Grayscale, because Grayscale had like $23 billion worth of Bitcoin. And like I said, they have a high fee relative to the others. So they're charging 1.5% to people, whereas you can go to Valkyrie or Bitwise or whatever and get 0.2%, 0.3%, whatever. And they need those high fees because their parent company of Grayscale, DCG, is in major financial straits. It's like one of the only things keeping them solvent. So they're going to probably hold on to that fee, and they will continue to have outflows, at least for a period of time. And some of those are getting offset by the other ETFs. Some of them are. But you can see it's not lifting the ETFs. They still have declining volume, and they're not supporting the Bitcoin price because this market is bigger and deeper and more complex than any one of the pundits talking about this event are giving it credit for. And now you can hear some of the narratives are pivoting to, well, at first it was, oh, it's going to be the announcement. The announcement is really bullish. You have no idea. The announcement came and went. Nothing really happened. We had the fake tweet the day before, which maybe sucked a little bit of the air out of the market, maybe sucked a little bit of the wind out of the sails. But then it was shifted to, okay, well, the announcement didn't quite go as we thought, but it'll be day one. Day one launch on Thursday. Get ready. Well, we had the day one launch. It was good, but price sold off. We had solid volumes. Everyone has made a big deal about the volumes, and the inflows on net across the whole complex have been okay. They've been decent. Like I said, BlackRock has $1 billion worth of BTC, but they haven't been supportive of price. And so now now that the launch didn't go well, the narrative then pivoted to, okay, well, maybe we have to wait for settlement, right? Because in the TradFi markets, when you sell something, there's a T+2 delay. That T+2 means transaction plus 2 days. When you hear someone say T+1, T+2 settlement or whatever, what they mean is you sell your stock, you don't get the money back for 2 more days. That's just how it works. There's a rollover time. And a lot of people thought, okay, well, GBTC sell pressure, we just have to wait 2 more days. And then suddenly everyone who sold out of GBTC, they're just going to buy into the other ETFs. Well, maybe that's happening. We need more time to know that. When we look at the data from Eric, you can see there are flows. They're not completely negative. And even though GBTC has negative 1.6 billion of flows, there's another billion that went into BlackRock. Like on net, it's positive, right? So I'm not trying to paint a picture that it's all negative. But I have noticed, it's been very clear to me, a constant moving of the goalposts around the expectations for what the ETF was going to do to price in the short term around the launch. I have no doubt in my mind that over the long term, this will be another avenue for people to access Bitcoin. No doubt. That's great. But it doesn't mean a bunch of crazy things in the beginning, right? There's a lot of learning that has to be done. These advisors, they need to learn more about Bitcoin. Many of them are still on like level 1 knowledge about BTC. Then they have to convince their clients to take on the volatility of exposing themselves to this thing. Even though that there are people in Bitcoin who will try to convince you that it is a no-brainer investment, and maybe they're there mentally, maybe they're already at that place where to them it's a no-brainer. For a lot of people, it isn't. And that will take time to convince them otherwise. So we'll see how it goes over time. But in the interim, in the initial launch, many expectations were broken. And now that it's several days on, we're more than halfway through the first, we've now seen a full week. At the end of today's session, the Thursday session, we will have had, well, I guess 4. Monday was a holiday. We will have had 4 full trading days of this asset, 5 full trading days, counting Thursday. So Thursday, Friday, Tuesday, Wednesday, Thursday. So it is 5. Okay, sorry. After today, we'll have a full week. We'll have a better idea of what the flows look like. Eric's been doing a good job tracking it. It is net positive, though it isn't anything insane. And now the narratives are shifting. Now that we've gotten past the announcement and it wasn't what people thought, we got past launch day, it wasn't quite what people thought. It's been a week, so T+1, T+2, T plus MLK day, none of those things have manifested. The narrative now is just wait for the halving. Well, we've got a halving coming in 3 months. That's going to cut daily issuance in half at the same time that we got BlackRock. They just scooped up 25,000 Bitcoin in a week. Do the math. We only got 12 more weeks till the halving. 25,000 times 12. That's a supply squeeze. Like, this is the math people are doing. I don't think that any of that's true. I don't think the halving is going to make a lick of difference. It's a narrative, and no one will question the power of the narrative. But there's ample evidence to suggest that the halving will not be significant in a mechanical way. And I can show data that supports those things. So, for example, these 2 lines represent 2 different ways of calculating annual issuance. That is the amount of new Bitcoin that is mined every day as a percentage of the active supply. So we know every day there's 900 BTC that come to market, right? And before the prior halving, it was more than that. It was 1,800 BTC a day. It gets cut in half every time. And when it gets cut in half at the next one, it'll go down to 450. And most of the narratives around the halving and why it's important center on the influx of new supply. And people think that the influx of new supply is satisfying existing demand. And that when you cut that supply in half, that the demand staying in place necessarily becomes doubly as important. And if your framework for the market is an economics 101 understanding of Bitcoin, then that would make sense to you. Because you have all supply on one side, all demand on the other side. You cut the supply in half, the demand weighs more, right? Like I get people's mind and how they get to that place, but that isn't how the market works, right? All the supply doesn't sit in one place. It's actually very segmented. And new issuance coming in every day is just throwing a penny on top of a very large pile of Bitcoin. 93% of 21 million coins are already circulating. And I think that one of the disconnects for people is that they see the supply held by long-term holders as unavailable. They think that because the supply now sits with somebody who's not interested in selling right now, that means that supply is off the market. And that anyone who wants to fight over Bitcoin now has to get what they can see right in front of them, which is the 2 million on the exchanges and the 900 that are being mined per day. But that isn't how it works. There's a whole lot of other BTC out there, and there are multiple ways to get access to it. People constantly underestimate the market's ability to find supply. They constantly do it. And what these two lines are showing you is that the daily issuance of coins, the new BTC that arrives in miner wallets every day, is becoming a lesser and lesser percentage of the amount of Bitcoin that trades in a given year. So these lines are annual issuance as a percent of all of the supply that transacted in the past 365 days. And even though the halving continually chops that number in half every 3.5 to 4 years, that percentage continues to drop because the market is bigger than daily issuance by a fuckload. Additionally, the volume that comes out of long-term holders, those are people who hold their Bitcoin for 6 months or more. I'm rounding. It's more specific than that, but roughly 5 or 6 months. If you hold your Bitcoin that long, then you get bundled into a group called long-term holders. That's the blue line you see right here that's representing that group. And long-term holders have a lower percentage likelihood of spending their coins. The longer a coin sits dormant, the more likely it is not to be spent again. That's kind of a fundamental truth of the supply. And there's a lot of lore and like fairy tale that gets built in around the concept of long-term holders, right? People think of them as diamond-handed, invincible market participants who are riding this to the end of fiat, right? And for some percentage of Bitcoiners, that is true, but it isn't true for most of them. And what we see in bull markets, particularly as price breaks into new highs, we see spending out of long-term holders. The distribution of old supply into new hands is a fundamental mechanic in the bull run. It's fundamental. It happens every time. It allows distribution to occur. It allows for new holders to join the market. Because if they are not sold to, they don't become Bitcoiners. Someone has to make them a market, and people do it every time. You may not, others do. And even now, even with price well below the all-time highs, which is where long-term holders usually do most of their business, is at the highs. They pay themselves in profit. They don't spend at the lows, typically. But there's still some volume among long-term holders that moves around on a daily basis. This blue line is the 3-month moving average of the amount of Bitcoin sent to exchanges every day by long-term holders. You can see it's about between 1,000 and 2,000. These two lines are here. That's on average. It's about how many it is. And that goes back a ways. If I zoom this out, that number is pretty consistent, even back to 2 halvings ago, right? Between 1,000 and 2,000 BTC on average on a given day is sent to the exchanges from long-term holders. Sometimes more, sometimes less. When it was much higher, this was during the bull run. Like if I add Bitcoin's price on here, this was during the bull run, right? You see that? This is where you notice most of their activity. However, they do have baseline activity no matter what. And what we can see is daily issuance, which is here in pink. This is the amount of Bitcoin that gets mined every day, is not as much as the amount of Bitcoin that gets sent to exchanges from long-term holders every day. So even these lauded hodlers, these storied diamond-handed investors who everyone talks about all the time because they're the most exciting cohort in Bitcoin for some reason, even that group is constantly sending supply to the exchanges. Sometimes it's not a large amount. You can see there are valleys where it's quite low and it's actually less than daily issuance. But on average, it's about the same. And this pink line is about to get cut in half again, down to here somewhere. And then long-term holders will be sending more to exchanges every day, more than the issuance every day on average. Rather than it chopping around, they will consistently be providing more supply to the market than issuance. And that's why the halving doesn't really matter. Now, this is not all supply. This is not all sell volume. This doesn't represent the entirety of available Bitcoin being sent to the market. This is just one cohort. This is long-term holders. And they're going to known exchanges. Remember, there are institutions that are not in here, right? So there are long-term holders sending to exchanges, and that number, sorry, I'm bouncing around, that number is not appearing in this blue line because Glassnode doesn't even have Robinhood on here. So it's probably a bigger number than this. The blue line is probably a bigger number than this. But because they only know so much about the ledger, because we've only identified so many entities, we have to go on what we know. And based on what we know right now, long-term holders send as much or more to exchanges every day than is mined. So if we cut the issuance in half, long-term holders outweigh it even more by 2x rather than 1x. So I think that this is the kind of thing I want my audience to be knowledgeable about. I don't want to be the only person who has this perspective on Bitcoin. Now, if you disagree with me, that's fine. I'd love to hear about it. I'm open to discussing this. But I'm providing data to you, and I'm providing insight that almost no one can give you about the way that on-chain works, because there's only a handful of people who have the same knowledge that I do, because most people don't take the time to learn, right? There are others who could probably debate me with the same data I'm using, and they know what they're talking about, and that would be an interesting conversation. But most people who talk about this stuff don't take it to that same depth. And so they end up talking about dynamics that they just don't understand in full, and they create narratives that don't attach to the underlying data. Alvaro, I just explained why the halving doesn't matter. Because the volume of the market significantly outstrips the halving. Because the amount of daily issuance as a percent of the supply that churns around is falling over time. Because the market is getting bigger and bigger. Because 93% of all Bitcoin is already loose. Why do people think that the next 900 BTC matter more than the 93% right now in circulation that somebody holds? Why do people think it matters more? The data does not support that. And if you're curious about more of my thoughts on the halving and how it relates to past cycles, then I suggest you go to my channel, go to playlists, view the Recession Roundup playlist, and watch this video right here. Recession Roundup Part 4. Bitcoin follows the economy, and it always has. Watch this video. It'll give you some more of my thoughts, some more charts that I haven't pulled up here because I didn't want to just recap that whole video. But Bitcoin has followed economic forces since its inception. It's been influenced by them. Let's phrase it that way. Influenced by them. Did you know that Bitcoin breakouts above its prior all-time high are more closely connected to breakouts in the Dow Jones than they are to Bitcoin's own halvings? By 3x. It's about 61 days between when Dow Jones breaks above its prior all-time high and Bitcoin breaks above its all-time high. About 61 days. It's about 200 days between the halving and Bitcoin making an all-time high. So ask yourself which factor actually matters more. That's just one data point. I just spent 45 minutes giving you other data points about how long-term holders provide more sell pressure, quote unquote. It's not sell pressure. I hate that term. I used it reflexively. Long-term holders provide more transfer volume on a daily basis than issuance does. The amount of issuance as a percent of the Bitcoin that is actively transacted is falling over time, falling since inception, continually structurally declining as the market grows. Now, the halving back here in 2012, that one might have had more of an impact because at that point in time, only 50% of the supply was issued. Most of the Bitcoin market was P2P. BTC itself was the trading pair for any other coins that happened to exist. I don't even think there were any coins in 2012. It might have just been Bitcoin. But by the next halving in 2016, that was true. We had altcoins, and BTC was the trading pair for most altcoins. There was still a ton of activity that happened on the ledger. There was still a lot of P2P transfers that happened. We didn't have such a broad and robust derivatives market. We didn't have as large of a stablecoin market to absorb some of that volume. It was all BTC. And by this halving right here, only 75% of the supply had been issued. So that's my thoughts on this. I think that we're in an interesting elbow turn secularly, in my opinion. I think we're at a place now where TradFi is here. They now have access to Bitcoin. They are currently trading it up. Price breaking down a little bit. Look at that. Might break some of these lows on these ETFs. We'll see. But we started talking. BTC was up here. Now it's down here. It's breaking down a little bit. Just a little. TradFi is here. The market is significantly larger than it used to be. Derivatives volumes, meaning perpetual futures markets and options markets, the volumes over there are larger than the spot market by multiples. And we're at a potential turning point in the macroeconomic landscape, which we've been talking about quite a bit for about the past year now, maybe 9 months. And I think that it's going to be difficult for people who only pay attention to BTC and crypto, either because they're a new market participant or because it's the only thing they find interesting or whatever their reasons are. I think that this period of time will be difficult for those folks because Bitcoin has a lot of its own narratives that were built in a supportive environment for the last 15 years. Largely supportive environment. And I believe that environment has structurally changed. And so we're now coming to a place where the narratives that drove Bitcoin and that people subscribed to will soon run into frictions that oppose their natural ascent. And so things like the halving and supply restrictions and 4-year cycles and things like that, those things will now be challenged by adversarial macroeconomic factors like higher interest rates. They are higher, right? Higher for longer wasn't a joke. It's been 2 years. The rates haven't come down. And I think 2024 will be an unfolding of those things where Bitcoin's narratives run into macro narratives and forces, and we find out which one really dominates. And I suspect it will be the latter. Let me take a sip of my beverage here. Quite a few things popped off in the chat. I'm going to catch up with you guys, and then with our remaining time, I'll answer your questions. And then there's another thing that I wanted to touch on related to the central banks. But I wanted to mostly get my thoughts out there about Bitcoin, about the ETFs, about the possible reversal, technically, that we're looking at on BTC, on this sweep of a 2-year high, on all-time or on 3-year high volume for Coinbase. We had all those other instruments with the same kind of a reversal structure, GBTC, the short ETF, the long ETF. Excuse me. Also, BTC1, the CME future, forgot to mention that one. All-time high volume on Thursday. All-time highs at the same time that it did the same sweep. Swept this high right here, the 2022 high. Swept it on the highest dollar volume in the history of CME, Bitcoin CME. But that looks like a fucking reversal. I'm sorry. All right, viewer activity. Let's see what we got. Hugh with the donation says, I'm sure it's your great ability to present the data, your arguments on the data, but why do you think more people can't see what you do? Peace. Thanks for the donation, Hugh. Very generous. I can't really answer for other people. I don't like to think that I've got some special truth that they don't have. But I know that I have a perspective that I built from my own research. Right? I don't take other people's word for it. And what I see a lot of is really bad proliferation of really bad information. I see that a lot. It's very easy to share something on Twitter without doing any research just because it sounds good. And if you have a big account, then you just create an exponential effect of more people doing that because you have the big account, because people follow you. So if you share a thing, other people will just share it only because you did, right? Like that's just how it works. We're social creatures. And I see a lot of really bad information out there. People either don't understand the on-chain data and the depth of the market. They think that stuff like this are all encompassing and that there's no thought that they have to put into it. Oh, this is all the BTC on all the exchanges. It's going down. I know what that means. I took economics in college and we talked about supply and demand, and Bitcoin's supply is fixed. And so I'm going to apply all those things I learned in college to Bitcoin's market. That's not how it works. Not in a holistic way, right? Maybe in certain corners, in certain situations, it works that simply, but the market isn't that simple. So I don't know. Kane with the new membership. Thanks for joining, Kane. You'll have access to our private member stream the next time we do one of those. Crypto Prepper also joined. Welcome, brother. Welcome. Let me scroll back in the chat. I see a bunch of people adding me. So let me answer your questions, guys. Macro Anarchy says, oh shit, this is pretty damning. I don't know which thing I said that was damning, but I'm glad you're enjoying it. JB says, what are my thoughts on a debt jubilee? Well, debt jubilee is sexy. But I don't think that that's likely unless we are in severe economic straits. Because if the debt jubilee was that attractive of an option, we probably would have tried it already. We probably would have tried it after the GFC instead of just committing a massive transfer of broken promises from the financial sector to the household sector to the public balance sheet. Because that's all we did. That's all we did during the GFC. We just transferred. Let me see if I can find my chart real quick. Debt by sector. Yeah. Right here. All we did in the GFC, we had over-indebted financials, banks here in green. This is debt to GDP. Financials, over-indebted in the Great Financial Crisis. Same thing with households, debt to GDP. These were at all-time highs. And what did we do in the GFC? We just transferred all those promises to this purple line, which is public debt, which is you and I's pocketbooks and the generations ahead of us pocketbooks. That's our tax dollars, right? We now owe this money. So there was just a great transfer of promises from these two sectors, from households and banks, into the public purse to take away from future gains. That's all that we did. And I think that we're just going to try to do something like that again until the system rejects us, till we have some kind of a sovereign debt collapse or we have a currency crisis of some kind. I don't think that there is an appetite to do an actual debt jubilee as long as the U.S. is the global reserve issuer, where they just forgive all debts. Centuries ago, certain civilizations had those on a regular basis, like on every 10 years or something. They would just do a debt jubilee and just delete everything. I think we're a long way from something like that being realistic. Flows have nothing to do with volume. Flows could be 1 billion and volume 0. Yes, Julian, they could if you have access to like having an OTC market, which is what Pantera Capital did to Bitwise. That's the whole reason why the Bitwise ETF has 370 million of flows and 300 million of volume. Yes. Volume is just people trading the shares back and forth. Right. Happy to catch you live, says Jacob. Thank you, brother. Welcome. Big Shroom says, I like the stream, yo. Welcome. Blockchain backer, hard F. I don't know what that was from. All right. David says, you will have to have a warning if you have soup on markets in the morning. BCB for the language. Oh. Yield curve about to invert. Well, let's go check on some of these yield curves, will we? Shall we? Let's go see. Here's the 10s, 2s. Hasn't uninverted yet. Still another 20 basis points, which is actually the level that it's been under this like whole cycle. So we'll see. Don't get too excited. Just because the 530 or something uninverted doesn't mean, I see people talking about this one. The 5s, 30s uninverted. Probably one of the least looked at of all the yield curves. It just is. It's just not that important. Like the ones that people look at are the 130, are the 10-2, are the 10-3 month. Stuff like that. Like 2s, 30s. 530, I don't know. That's just one of them in the middle. It's uninverted. That's good. We'd like them to be uninverted. We'd like them to not be inverted because this makes banks' business models unprofitable. 30s, 2s, very close, but 10s, 2s, like we said, still down here. The 10-3 month, way the fuck down here. This is the one we use in our recession modeling, the 3-month 10-year yield curve. And it's way down here. The 10s, 2s is the second most popular one for recession modeling and business cycle dating and things like that. And it's still inside of the same range it's been in. So we'll keep our eye on it. But right now, it isn't uninverting. The ones that we find most important are not uninverting. Some of the other ones are, though, like whichever one I just said before, 30s and 5s. Alvaro, what you're saying means the halvings matter less and less. It doesn't mean the halvings do not matter. I mean, they are asymptotically trending towards not mattering at all. So... like we can nitpick about it, but let's just be honest. Here's a lot. Here's 0. Here's how much the halving mattered at the beginning. And now we're just like this as we gently drift down to 0 because we issued 50% of the supply and then 25% more of the supply and then another 12.5% of the supply and then another 6.25% of the supply. And now we're like right here. And 93% of it's already out there. So no, the halving doesn't matter 0%, but, maybe it matters 0.5%, It is asymptotically trending towards not mattering a hill of beans. August says because of emotions and wishful thinking is why most people can't see this. That's true. People want to believe things. My buddy Joe Carlosari asked me this morning. Where is it? Here it is. Because I tweeted out the points that I just made to you guys. Cutting daily issuance will not make BTC more scarce. The supply is still increasing. And yearly issuance as a share of active supply is falling. And long-term holders provide more supply to the exchanges on a daily basis than is issued to miners. All I did, I was just making those points and saying that while no one denies the narrative power, I'm not denying the hype factor. There's ample evidence to suggest the mechanics are overstated. And my buddy Joe says, why do you deprive people of hopium? No, Joe's kind of joking around. Joe's a lawyer, and you know he's joking. But my response to him was, long ago there was a young man named TXMC who didn't know shit about markets and was easily swept up in narratives. But after losing his ass and blowing out several trading accounts, he has transformed into a living conduit of facts and vowed to wage war against the forces of untruth. Because I lost my ass a lot. Especially the first couple years of trading, I started using real money way too soon. I started taking high risk, blew thousands of dollars. There's been more than once where I have clicked a button and my entire trading account has been vaporized. I've done that to myself more than once, not in crypto. Before I made my persona, when I was still trading equities, I've done that to myself. And it's because I get swept up in narratives, right? One of those narratives was marijuana legalization and marijuana stocks. This massive bubble. I traded in here. I got my ass handed to me. CGC, I used to own some of this. MJ, the MJ ETF, Alternative Harvest ETF. I used to own some of this. I literally bought it up here. So I've gotten swept up in narratives. This is just one example. This is the one I first thought of. It's happened a couple of times. Same thing after COVID, like right when COVID hit and the market tanked and then it reversed. There were all kinds of narratives driving certain pockets of the market, but it was just it was a frenzy. You know, it was insane. It was a V bottom. But even then, I found ways to lose money while the market was going higher because I didn't have a foundation of understanding about the markets. I was just reacting to things as they were happening. And I feel like a lot of people do that. Kurzak says, can you tell us how I see SPX in the next few weeks? Sure, we'll look at SPX. See if I can if I have a sharp opinion about this. I have been waiting on S&P to break into all-time highs because the NASDAQ and the Dow Jones already did, right? The NASDAQ did, the Dow Jones did. So I was waiting to see if the S&P did that. I don't really know. It's been difficult for me to ascertain the differences between these three because they kind of do different things. Dow got way out ahead of the rally really strongly, and now it looks like it wants to come back down and test the prior all-time high. S&P hasn't even gotten there yet. I don't really know I don't really know the trend of where this is going. But if I look at breadth, I think I was looking at this yesterday. Yeah. If we look at market breadth, we can see it's starting to turn and roll over here. The blue line is the number of stocks in the S&P that are above the 20-day moving average. The yellow is the 50-day. The red is the 200-day. And they're all starting to roll over here. The 20-day is more of a short-term oscillator. But if I take that one off, let me take off the 200 as well. Just look at the 50-day. This is about where it maxes out at. Right here. It's about the place where breadth tops out at, about 88 to 90% of stocks being over their 50-day moving average. So that's roughly the high. And if you zoom way out, that's consistent for a very long time, right? About 88, 90%. And that's what we tagged, which suggested we were at maximum bullish breadth, maximum expansive breadth, and the market needed to pull back some. So seeing the momentum of breadth rolling over here. This is another way of measuring breadth, market breadth. Advancers versus decliners on a moving average. That's breaking down. The number of stocks over the 50-day is breaking down. The number of stocks over the 200 has rolled over from a place that was a local high, but it has been higher before. But that's about the high that it's been for this cycle since the bear market started. Look at that. Look at that. So here's the all-time high. Let me draw with my other tools. Okay. Here's the all-time high. Right? Here's the all-time high on breadth. This is the all-time high, or sorry, this is the all-time high, and this is breadth. This is stocks trading over their 200-day moving average, which is the red line up here, the red moving average. And look at that sweep right there. Now, this is not a price chart, but it's a market, right? It's the breadth of the behavior of a bunch of assets that go into this index on a market cap weighted basis. So it's a slice of market behavior. So you can do TA on these things the same way that you can do TA on yields, because people react to and trade the yields, even though it's the price of the bonds that you're actually buying and selling. So we can do TA on market breadth, and we see a clear sweep into what has been the highs of this cycle. Doesn't mean it can't go higher. No, that's not what it means. But if we're just looking at this contextually in the context of the last 2 years of market action, that looks like we reached a local top on the S&P. Alvaro donated and said, I like it when you yell at me. I'm not yelling, brother. I'm not yelling at all. I'm just a passionate person. Sorry if it came off that way. He says, your streams are worth gold. Very few people providing this much insight. Thank you. Thank you. I appreciate that you consider it to be insight, because these are just my views. I'm glad that they're valuable to you. Evan says, I can't wait to short NVIDIA. Let's look at NVIDIA. NVIDIA has surprised me. I'll be the first to admit it. When it first popped up, see how I have this box drawn right here? I drew this box months ago. And I kept expecting that when we had this gap up here to 365 and then we pushed up and it started breaking down like this, like when we were here, that looked like it wanted to go. Like we didn't get the close. We didn't get the key close below this level, which is the tell for a market structure break. We didn't get that. But see, look how close it was. Look how close it was to actually closing below that level. I had to zoom in like a million times just to see that. So we didn't actually get the close to show the breakdown in market structure, but it looked really ugly. And we had this gap beckoning here. And that was before the reversal of the market, when things started to look bearish, right? Because we had yields pushing higher. Like, right, if we look at the 10-year here, we had yields pushing higher into this moment right here. And I thought, surely this will be the gravity that pulls NVIDIA back down and at least fills this gap in, this gap that's right around its all-time high, its prior all-time high. But that isn't what happened. That isn't what happened, you know? I'm not trading NVIDIA, by the way, so it's not like I lost my ass on this. I don't trade individual tech stocks most of the time. But it's been pushing higher. And the thing about this is that the other big tech names aren't really doing that. So like Apple is down here, Amazon, Google, Meta, Microsoft is still at its highs, but it's cooled the last 3 days. Tesla looks like shit, and Nvidia is just ripping. It looks like the only thing that has volume. That's not a healthy market, guys. That's not a healthy market. Usually, if you have a sustainable uptrend, stuff like the Russell is going higher, not breaking down significantly after a sweep of the prior year's highs. That's not usually the thing you see at the beginning of an expansion, right? Same thing if you look at some of the credit markets, they're still significantly down from their highs. This is high yield corporate credit. If we look at investment grade corporate credit, it looks the same. These are also instruments that turn around and bounce when the market bounces. Look how they bounced in COVID, right? Right back up to their highs. But they started breaking down when the bear market started, and they're way the fuck down here. This is a big ETF. LQD, a lot of people trade this thing. If we look at some of the breadth inside of equities, I know we looked at the S&P, but I mean, let me show you. Here's one. This is the S&P versus the equal weighted index, right? Because the S&P is market cap weighted. So the bigger the company, the bigger the share of the S&P that you hold. Well, RSP is the equal weighted S&P. So S&P over RSP is market cap over equal weight. So when this breaks down, it's showing you that the broader market is following the primary trend. When this goes higher, it's showing you that the market cap leaders are outperforming the rest of the index. And for most of 2023, that's what we had. This huge move higher, which is the same thing that happened when COVID happened. We had massive outperformance of the largest companies in America, right? The top, call it 10 stocks, greatly outperformed the rest of the index. And then they swept these highs. And I thought, well, maybe that means we're in a period now. Maybe that's the end of the run. If it's the end of the run, I was thinking back here, maybe this is going to be something that happens near the end of the uptrend. If we're going to have another sustained downtrend, then I would expect, similar to 2022, that this would break down rather than continuing to go higher, especially after sweeping the local highs from COVID. But it did start breaking down. It started breaking down in the last couple of months of the year, but now we've just reversed again. And in the last 2 weeks, it's just shooting higher as, once again, the Magnificent Seven are leading the way. And it's really just NVIDIA and partially Microsoft, as we just explored, right? We just looked at all the names. Microsoft is up. NVIDIA is up. But many of the others are not. They're down here, right? Google's performed okay. Google's kind of near its highs. No, it's not. It's not near its highs. But we're seeing that kind of outperformance again. Same thing with the Russell. This is the Russell 1000, which is the top 1,000 stocks. The S&P 500's inside of that. Russell 1000 over the equal weighted Russell 1000. Same exact shit. Same shit. Huge move up in 2023. Started to break down and you thought maybe we're having a rotation, but nope. Just resumed the trend right back up. Market cap leadership once more. And I think it's all the return to normal trade. All of this is the return to normal trade, which we talked about last week, right? The expectations of the market for massive interest rate cuts this year. That was what drove the Q4 rally. And now that we're seeing some of those pressures abate, we've gotten some stronger economic data in the last couple of weeks. The retail sales report was pretty good. Initial jobless claims were the second lowest print since the 1960s. You heard that correctly. We had slight acceleration in some of the cyclical metrics like industrial production and things like that. They've ticked up just a little bit. They're still not outperforming, but they're looking a little better. And those things are starting to make the market question the narrative that drove this move. This move was driven down because people believed that we were at the end of Fed tightening, that cuts were right around the corner, right? It was the return to normal trade. Where do I have my return to normal trade? Oh, I don't have it on here. I have too many tabs open, guys. Sorry. Let me go find it real quick. TXMC trades, global consensus. I always remember words that are in my tweets. This chart here, right? Market's expecting massive interest rate cuts in 2024. And so because the market is expecting massive cuts, including 110 in the US, we saw a huge bid into long end treasuries at the same time that stocks and Bitcoin ripped. Everything ripped. But now we're getting stronger economic data. Inflation ticked higher in the UK. And if the economy is going to stay strong and we're still going to have secularly tight labor markets, then the Fed is going to struggle to find a lot of justification to provide the cuts that the market is currently pricing. Here is initial jobless claims. I'm going to put it on log scale so we can see the low values more easily. This value that we just got on initial jobless claims is the second lowest print in this cycle. The low was here in October of 2022, late September, early October. We got another one here. It was 187,000. That's very low. And if we zoom out, that number is the second lowest number since the 1960s. The only one that's lower was October of 2022, over a year ago. So the labor market is very tight, even though the rate of growth of jobs is slowing down. That's what we've talked about a lot on here. This has been our skeleton key for the economy. The rate of growth of job creation, the actual employment of America. That black line continues to follow the pre-recessionary path here in the gray line, where our only example that we could pull from of a soft landing in the purple had, by this point in that cycle, had already begun to reaccelerate. But here we are, and we're still following that trend, even though some aspects of the economy look like they're reaccelerating. But I would suggest to you that any reacceleration that you're seeing in January and February economic data is because of this right here, is because the 10-year absolutely fucking collapsed. What is that? 124 basis points in like 2 months. The market did this to themselves. Fed policy did not change one bit. And the market did this to themselves. The fastest easing of financial conditions in the history of the data. Did you guys know that? Did I say that to you last week? I don't remember. But I'm going to show you the chart real quick because it's important to look at. Here it is. The fastest easing of financial conditions in history. And it didn't come with a change in Fed policy. So these other big spikes here, these were changes in Fed policy. The Fed doing that. This one right here in 2003, that was Greenspan cutting interest rates to 1%, even though the economy was already recovering from the tech bubble recession. Here, this was the beginning of QE and the Fed cutting massively in the great financial crisis. And here we are today, having surpassed both of those major easings, and that was completely market driven on the attempt by the market to front run rate cuts that probably aren't coming. My buddy Blockchain Backer said the other day, his exact words, and I'm going to repeat them: the market is front running something that isn't coming. That's exactly what they're doing right here. They were wrong about hikes to the upside. The market thought we would get this last year. We got all of this. Every single jurisdiction, except for Japan, was wrong to the upside. They got many more hikes than they thought. How likely is it that those exact same market participants who are, with every breath they take, betting on a return to normal, how likely is it that they are all wrong again? It's very likely. And you know what? Christine Lagarde agrees. The chairman of the European Central Bank, president, excuse me. I saw this article yesterday. I'm going to read a couple of points off of it because I think it's interesting. Global stocks drop as hopes fade for early interest rate cuts. Lagarde says the Eurozone is likely to cut in summer later than markets expected. They were expecting cuts as soon as March. Worldwide sell-off came after ECB President Christine Lagarde signaled that borrowing costs would come down in the summer rather than the spring, following the first rise in UK inflation in 10 months. This is the kicker right here. Lagarde said market expectations for a rate cut were, quote, not helping. The market is not helping this. They're making this harder by constantly trying to front run the change of policy. The Fed says, we think we might be done hiking interest rates. What does it do? The market engineers the fastest loosening of conditions in fucking history without any change to policy. And now Lagarde is saying, y'all are not helping. The losses spread to the U.S. as strong retail sales data cast further doubt on the prospect of early rate cuts by the Fed. Data showed that spending in December accelerated at the fastest pace in 3 months. Her comments were backed up by Klaus Knot, head of the Dutch central bank and a member of the ECB, who told CNBC on Wednesday, the more easing the markets have already done for us, the less likely we will cut rates. The less likely we'll add to that, meaning the less likely we will contribute to the easing that is already happening. The market is front-running something that isn't coming. And what I keep going back to again and again and again, what I keep returning to, and I'm going to show it to you guys again for the 100th fucking time, and you're probably sick of seeing it, is this chart. All the debt, all of the psychology of the market is anchored inside of this yellow box during zero interest rate policy. Everyone's behaviors are anchored to this period of time. And they all believe that it is just a matter of more time, relatively imminently, that we will return to this yellow box for whatever reasons they've decided. But because we have inflation, because we overstimulated COVID, and because the market is obsessed with front-running policy changes by central banks, the likelihood that we will go back to this place is diminishing. It's getting farther and farther away, barring a significant crisis, in which case it doesn't matter what I'm saying right now. But if we're going to continue moving forward and expanding, there is a massive delta between what the market actually needs in order for all the math to continue making sense and what the Fed will probably actually give them. But the market hasn't figured it out yet. They're not that efficient. The market is efficient at taking information and going and reaching a conclusion with it. But that conclusion is often wrong. Not always, depends on the asset and the time period. But sometimes those things are wrong. And right now, the market is wrong about rate cuts, in my very strong opinion. Let's touch on one last thing related to all of this. 2 days ago, Fed Governor Christopher Waller, who I believe is the head of the New York Fed. Let me see. Christopher Waller is an American economist, member of the Federal Reserve Board of Governors, St. Louis. Previously executive vice president of St. Louis. Which one is he at now? Why doesn't it doesn't say that on here? Let me go FOMC. This is not a material. I don't know why I'm so obsessed with figuring out which fucking bank he works at. Is his name on here? And I'm just missing Waller right there. It just says he's a board of governors. Okay. I don't know which one it is. Doesn't matter. John Williams is the chair of the New York Fed. Christopher Waller gave some comments. He gave a speech about Fed policy, about this cycle, about what he thought was going on, about how the data has been stronger than they thought, about how they were surprised that they were able to tighten this much without creating a lot of joblessness, in part because job openings were so high, right? That's something we've looked at quite a bit together on here, is looked at job openings. We've modeled all those things. If we look at them here, you can see they were very elevated relative to the past, and they have been squeezed back down, and we're nearing the place that we were at before the pandemic in terms of job openings. And this was a channel that the Fed was hoping they could access by tightening in the way that they did. They were hoping they could make this number come down without making unemployment go up. And so far, that has been successful. That has proven true. Whether or not it will end that way is unknown. But so far, they've been able to do that. He talked about that quite a bit in here. And then near the end, he starts attaching it to monetary policy. So this brings me to the implications for policy. He says the progress we've made on inflation, combined with the data on hand for economic and financial conditions, has made me more confident than I've been since 2021 that inflation is on a path to 2%. I believe policy is set properly. I don't know why he keeps highlighting all these. I believe property is set policy. It's restrictive, and it should continue to put downward pressure on demand. And then he says, as long as inflation does not rebound or stay elevated, I believe the FOMC will be able to lower the target range for the Fed fund rate this year, meaning that they think they'll be able to cut. This view is consistent with economic projections from December that shows our median projection was 375 basis point cuts. We've talked about that on here. That's what I tweeted in December on FOMC day, was that they were showing 25 basis points, 325 basis point cuts. Clearly, the timing of cuts and the actual number will depend on the incoming data. Risks that could delay or dampen my expectation for cuts are that economic activity seems to have moderated in the fourth quarter and doesn't play out, that the balance of supply and demand in the labor market, which has improved, stops improving or reverses, or if the gains on moderating inflation evaporate. So he's saying we're very data dependent now. They think they've gotten most of the way there, but the economy remains strong. And if we're going to have secularly tight labor markets, they've got to be very careful not to reignite inflation, because the moment, because of this, I think the Fed is aware that the moment they signal either that they are going to begin tapering quantitative tightening, not end it, but just slightly reduce the pace of it, or the first time they signal that they might cut rates, even if it's just a piddly 25 bips. The first time they mention either one of those things, the market is going to lose its ever-loving fucking mind. It's going to go crazy. Because that's what they did here. And all that Powell said was, I think we're probably done hiking. I'm paraphrasing. And that's all he did. They signaled 3 cuts in 2024, which is less than half of what the market actually thought they would get. And yet the market did this anyway, because everyone is betting on the return to normal. But Waller goes on. This is what he says at the end. This is the end of the speech. When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully. In previous cycles, which began after shocks to the economy threatened or caused a recession, the FOMC cut rates reactively and did so quickly and by large amounts. I'm going to read that again. In many previous cycles, which began after a shock to the economy threatened or caused a recession, the FOMC at the time cut rates reactively, and they did so quickly and by large amounts. This cycle, however, with economic activity and labor markets in good shape and inflation coming down gradually, I see no reason to move as quickly or cut as rapidly as in the past. The healthy state of the economy provides the flexibility to lower the policy rate to keep the real policy rate at an appropriate level of tightness. So we're back to the real rates thing. Some of you may recall that we looked at this chart of real rates before. This is the interest rate adjusted for inflation. And what we had noted was that because of everything that happened in Q4, because the market is front-running something that may not come, they loosened financial conditions. They lowered the real interest rate. Inflation is coming down, and the yields came down. And so if the yields had stayed where they were and inflation had come down a lot, then real rates would have gone up. But both actually came down, and we now have a net easing of real rates. So Christopher Waller is over here saying, some people think that we're going to lower the nominal, he even has that written there, nominal policy rate, the Fed funds rate, to keep the real rate at an appropriate level of tightness. Well, if the real rate has fallen 80 basis points from its highs, that has removed the 3 interest rate cuts that were priced in for the Fed for next year. Does that make sense to you? So if the market initially, because of the projections of the Fed, because on on the sheet that they released in December FOMC, I'm going to find my tweet so I can show you. Trades 75 bips 2024. 75 2024. Where is it? Here it is. Fed updated SEP, Summary of Economic Projections, shows roughly 3 cuts, 25 basis points in 2024, based on where the Fed funds rate was at the end of next year, based on the fact that they show it being 4.6 when right now it's at 5.5. That's what they showed it being at the end of this year, the current year. So that means roughly 3 cuts of 25 basis points. Well, this has come down more than that. Real rates have softened themselves more cuts than the Fed said they were going to do. And then you have Christopher Waller over here saying, with economic activity and labor markets in good shape and inflation coming down, I don't see a reason to move quickly or cut as rapidly in the past. Because the economy is healthy, it gives us the flexibility to lower the nominal rate to keep the policy rate appropriate. It gives us the flexibility. Well, if you listen to the central bankers like Klaus of the Dutch Central Bank and Lagarde of the European Central Bank, they're saying, listen, guys, you are not helping us. Stop doing this. Because if you do this, then we don't have to cut so much. He literally says that right here. The more easing the markets do, the less likely we will cut, the less likely we will add to it. So when we have the return to normal trade bubbling up and we have this big delta, I don't think the cycle's over. And I think that this year is setting up for an historic policy trap for the Fed. Historic policy trap. The kind that could go down for generations as being a massive fuck up. I think that that's a huge risk this year. I said that here the other day. This year is setting up as a potentially historic policy trap for the Fed, caught between the reawakening of their nemesis in inflation and the total arrest of credit markets due to the secular end of zero interest rate policy after way too fucking long. And then BCB, the Giga Chad Fractal God King, he swooped in with this scenario. The surprise scenario. CPI hits 2.9% after the next 2 readings in March. Then the Fed decides to cut at the FOMC at the end of March. Markets go euphoric, soft landing, holy shit, we did it. Then CPI rises because it doesn't take that much for CPI to rise just a little bit. Let's say it rises back to 3.5% in April. Then the Fed doesn't cut in May, because they're already setting up not to. And then all of a sudden people go, whoa, what happened? I thought we were cutting. I thought we were slashing rates. Why'd you guys stop? And that could be a shit show. Depending on where the market is at that time, depending on what kind of readings we're getting on economic activity, that could be a real barn burner shit show in April and May if BCB's scenario plays out even remotely accurately. Maybe it won't. It's just a hypothetical, but it's one that makes sense to me. The steps make sense. The timing kind of makes sense. And if that happened, if for some reason things turned around this period of time, that would be right here. That would literally be the tail end of our recession modeling framework. And it will have been the beginning of a downturn in the final month that we have examples for downturns. It doesn't have to play that way. We could still have a recession and it start back here. I don't know, but based on prior examples, the clock runs out around April. And that's kind of what we're headed for. How do I create those pairs? Evan Casey asking me. I believe, Evan, you were asking me about the equal weight versus the other S&P and stuff, right? You just make them yourself in TradingView. If you want to look at these things, you want to see the performance of the S&P versus its equal weighted self, type SPX over RSP. It's just a fraction, right? When it's going up, when it's going up, it's because the numerator is gaining. When it's going down, it's because the denominator is gaining relative to the other, right? So that's just how you read it. You can make this for everything. The Russell 1000. The other one I made was the Russell 1000, which is RUI over the equal weighted Russell 1000, EQAL. Same thing. Same chart. That's how you do it. Mr. Nobody, love the story about long ago. There was a man named TXMC. Yes, we've all learned how to be market participants in different ways, and most people learn in the most painful and savage way possible, and I certainly have. Fed pause window. Yeah, we're in the Fed pause window. I actually made the argument. Wow, that just popped strong right there, right as I started to zoom in, this candle went from here to up here. Something in the Russell just popped. Yeah, so I've thought for a while now that the pause rally, for lack of a better term, actually started here. I made that argument. I made that case to you guys here on my stream back in November. I made the case that we had begun the pause rally because the market was waiting to find out if Janet Yellen was going to dump a bunch of long duration bonds on them to fund the government, to fund the deficits. And she tilted back towards bills, which is more favorable to the market and for liquidity conditions. And so as soon as she pivoted there, the market took off, and I thought to call that the pivot rally, but it truly was over here. You know, when the yield started falling here, that was really where it was. I mean, I guess that was the same time, but once the December FOMC came, that's what I meant to say. Once we got the December FOMC and we heard what Powell had to say, that's really when the pause rally kind of like could have been said to have begun. But just because the market's been paying so much attention to Yellen and Powell, you could argue it started in October, November. Bitcoin taking a nosedive today. Is it? Oh, it sure is. Look at that. We're down to 41.4. We started the stream around 41.9, I believe. So we're breaking down. There are new lows on the ETFs. So sitting here, new low on IBIT. New low on GBTC, on all of them, which makes sense because Bitcoin's now at the lowest price that it's been in a few days, certainly since the ETFs launched. So it makes sense that they have all now sold off. Doesn't mean the trend has to continue. I think that it's still perfectly reasonable that Bitcoin pops one more time, but I do think that the vast majority of the upside has already been captured for Bitcoin before we go back down here. Down here. 10K before 60K. That's what I think. Hey, Evan, I appreciate your chat, bro. You're just kind of filling up the room there. If you could like make your lines a little bit longer. Just so I don't have to turn on the chat latency stuff. Just so that when I look up, I see more than just your name in the chat. Yeah, Alvaro, I know it's a tough sell. I get it, bro. I'm just trying to be rational here. And I think that these lows are not safe. And a lot of it has to do with the economic cycle that we're in, and the fact that if we do have a recession, equities are very likely to violate their lows from October of 2022. And if they do that, then it is extremely likely that Bitcoin does the same thing. Yeah, I appreciate it, Evan. I'm reading what you say. It's a lot. It's a lot to read, and I just don't want the chat to get. I don't want anyone to be discouraged from talking to you or saying anything to what I'm saying. How long would a significant crisis last? 24, 25? Yeah, I don't know. Alvaro. Because the problem is people think that, not you, but when I talk to people about timelines, a lot of people think that we get the catalyst. We go down because of the catalyst. They respond to the catalyst and then it's over. And then we go back up. But the thing is, what the actual sequence is that they tighten policy and then they stay there for a while and cracks start to form. And certain parts of the economy become weak because the momentum is slowing. Structurally, the acceleration slows down. And because there's more friction, because the cost of capital has gone up. And over time, weakness creates events. It's not that we don't have to have a catalyst to go into a recession. But if we have something happen at the wrong time when we have already established a foundation of fragility, which we have, despite the strength of the labor market in terms of joblessness is not blowing out. Initial claims, unemployment, those things aren't blowing out, but the rate of change of labor is slowing down, right? Hours worked, overtime hours, rate of hiring, rate of job growth broadly, all those things are slowing down. And those create fragilities. And so it makes it more possible to have a bigger, more drawn out downturn because one thing leads to the other. It's not ever just one event. I won't say not ever. It is rarely just one thing that happens. Like COVID was one thing and we did it on purpose. I say we, the government, they did it on purpose. They shut the economy down knowingly. They created a shock and then they immediately responded to that shock and we turned around and shot back up before anything else could happen. Look at the unemployment rate. It shot up to like 15% and then immediately reversed and started coming down really fast, faster than it has in the past. The markets bottomed, reversed, and went higher faster than they ever have before. But when we get into a longer cycle, the GFC is a good example. Like subprime housing started having weakness in early 2007. If you watch The Big Short, there's a period where the two young guys who work for Brownstone Capital, they're just laying on the couch watching TV. I'm actually going to find that for you guys. They'll probably cut my audio off. I'll see if I can. It's happening. Yeah, I'm gonna play this, but I'm gonna turn the sound. I'm gonna turn the. Okay. Oh man. Okay, forget it. So there's a scene there where the two young guys, they're laying there and they're watching TV in The Big Short, and what comes up on the news is I can't believe it. I can't remember if it's New Century or Countrywide. One of the old lenders is on there and it says subprime lender, I think it's New Century Financial, has gone under. And that when they're watching that, that's like April or May of 2007, like a whole year and a half before Lehman Brothers. And the market in 2007 was showing signs that there were problems, but assets kept climbing. And people hate the comparison to the GFC because they think that means that I'm making the case for GFC 2.0. No, I'm talking about the cycle, the business cycle, the cause and effect, the chain of events. I'm not talking about subprime repeating, but those weaknesses, like when you're seeing those guys hear about what happened to those subprime lenders, that was right here. The market was basically where it is today. Like this is their 22. Here's their bear market. This is a lot bigger than that. But this is what the S&P looks like today. Right here. This is what it looks like. We're right here. And all throughout the past year, we've had a lot of problems creeping up while assets continue to climb. We had a bank crisis 10 months ago. There's a lot of signs of stress. We have delinquencies rising. We've looked at all that data together. The credit markets have ground completely to a halt. Credit growth has stagnated, right? Let me show you credit growth. Where's credit? Credit growth is all the way down here. It is never that low. Let me zoom in. Credit growth is never this low on a sustained basis without having a recession. And it's all the way down there. We've definitely built in fragilities. And here we are. The market's continuing to climb. And that process that began in 2007, it led to just a few months later, Bear Stearns had a couple of funds go belly up like in the summertime. The Fed cut in September, and then the market rallied to a new all-time high. And Lehman Brothers didn't collapse for 11 more months. The market did not perform well in that window of time, but it was a long time. And it's because one thing after the other happened. Subprime lenders start going down. They can't pay back some of their loans to other people where they have gotten collateral or they've passed on collateral. There's calls on collateral. Some people can't meet the margin calls. It creates weakness in those people who lent to them. It creates a daisy chain all the way down. And the problem in 2008 was partially that there was a lot of interwoven exposure. Right? Lehman Brothers had a bunch of exposure all over the markets, all over the global markets. And so when they went down, it pulled the rug out of a bunch of other credit markets. There very well could be entities like that today. And if we run into credit stresses in 2024, if people find it harder to refinance, if the Fed doesn't cut as much as people think, if there's some reason why strength remains resilient, then they're going to be slower to act. And those things will create more risk factors. And then you end up in a scenario where everyone's thinking we're going to get this and we're still up here. That's how you create events that lead to other events. The kindling is laid, right? All of the ingredients for making a certain kind of meal are sitting on the counter. We're just waiting to start putting them in a bowl. And, I'm watching for signs of weakness. I think the bank pressures last March were the first sign. And I think we have a whole other phase of credit stress to go through this year. We'll see. It's impossible to call those things. But that feeds a lot of my hesitation in getting overly excited about people's lofty expectations for this year. All right. Time frames are very different, though. I don't know what you mean by that. I was just looking at a daily chart of the S&P. Time frames don't matter so much for those things. It's not something to be scared about. It's just something to be aware of. It doesn't have to happen. But when we get in these scenarios, more often than not, it does happen. So I'm just waiting to find out. And I'm okay with being patient. I think that's probably the thing that annoys people the most when they follow my content is that I'm too patient. Like I'm not reacting to data quickly enough for them. And maybe some of that is fair, but I do that on purpose because the approach that I have taken to modeling the economy requires me to do that. And that helps me from making bad decisions because as I told you before, there used to be a man named TXMC who got swept up in narratives and blew out a bunch of trading accounts because he would make quick decisions. So we're trying to mitigate our own personal weaknesses by creating a system that requires patience. So if you're still here, I appreciate you. Make sure you smash the like button. We're going to start wrapping up. This went really long. I was hoping to do an hour stream, but I didn't even say it because I knew I probably wouldn't. And here we are, an hour and 50 minutes into this bad boy. We will do another stream next week, and I will probably announce next week that our members stream will be the week after. So 2 weeks from now, we'll do another one of those. And if you'd like to be a part of that, consider joining the channel. I will show you where that is. Here. You go to my channel on YouTube, and there's this button. right now says join. You can if you want to. It's $5 a month. It's just a way to support me, and we do a private stream. So far, we're doing them once a month. We'll see where else it goes from there, but that's the current plan. I really appreciate all of you. Thank you, David. Thank you for your generosity and hooking up so many people with channel memberships and letting them have access to the private streams. I know that this is really long. I know I ramble a lot. I'm working on creating clips of some of my bigger points from my videos. You may have seen those coming out the last couple of weeks. I'll try to keep doing that and also try to improve on my just general organization as a streamer. I don't want to make you guys sit through 2 hours of rambling every week if I can do it in a better way. So I'm still trying to figure that out. I got to make it in a way where I'm still able to be creative and get into my flow, because I feel like that's when I have the most important things to share, is when I'm able to get into like a flow. And sometimes that flow just goes on for a long time. But that's it. We're going to wrap up here. So until the next time we chat, be kind to each other. Take care of your families. Give your mom a call. I can't call my mom anymore, and I wish I could. So call yours for me. We'll meet again in a few days. Maybe we'll have some better price action to talk about. We'll see. But I do think the secular high on Bitcoin is very near. I've long thought the 50K area would be the spot. And lo and behold, we created a very clear, to me, reversal structure on multiple Bitcoin instruments at that level. So I'm holding on to my bias. Maybe it pops one more time. Maybe it just does one of these. I don't know. Probably could take a couple of months, but that's my general bias, and I will hold to it until the data overwhelmingly confirms the opposite outcome. Do I have any good book recommendations? One book that I have been recommending over and over and over, and I will keep doing it until I hear more than one person tell me that they read it on my recommendation, is this book, The Price of Time. Right here, by Edward Chancellor. Phenomenal book. A couple weeks ago, I read an excerpt about China from this book. It's the history of interest rates, and then after that, it's the history of money. There's a lot of books that do that, but I like the way that this one does it. It's an easy read. If you're into history, you're going to love it. In the beginning, it's more about the history of interest rates, the first couple of chapters, but then it really gets into actual nuts and bolts history of money, what we've done over time, the responses by leaders, how those have been wrong, how we have evolved the way that we think about money and its relationship to the economy. It's fucking awesome. Awesome book. That's the first one I'll recommend. So that's it. Love you guys. Thanks for the support. Thanks for being here, hanging out for 2 hours while I talked ad nauseum. I'll see you guys on Twitter until next week when we do our next stream. Thank you, everyone. Take care. Have a great weekend, and I'll see you later. Cheers, everyone.